And now to our first conversation. Now, we'll be looking at the manufacturing industry. Now, we saw it recorded a negative growth of negative 1.91% in the third quarter of this year. And the contribution of the manufacturing sector of GDP also declined from about 8.96% in the third quarter to 8.59% of real GDP in the third quarter of 2022. Well, let's get a review now. Let's talk to Mr. George Onofo, CEO, Coleman Wires, join us here in the studio. Great to have you on the program, and compliments of the season.
Great, thank you. Thanks for having me back.
Wow, quite a year for the manufacturers. We've seen the forex issues, also had currency devaluation, rising cost of inputs, and others. How did you manage?
I think for most manufacturers, this year has been more of a roller coaster. But have we managed? I think we've managed better than most people expected. As a country by now, where we should be, it's more like disaster recovery. But I think we've fared better than most. The negatives we're seeing really should have been worse. But I think the major part of it for this year is that people planned for the worst. We did not assume a sort of optimistic year as we all estimated. But as each crisis did happen, really, because you were planning so far ahead, you managed the crisis better. The FX issues, the interest rate issues, inflation issues, all those were impacting us negatively, no matter how you say it. And by the time you put in the figures, of course, you're going to end up with a negative. So for most manufacturers that have even come up with a negative and a decline, that we had a GDP at 8.96 and a negative position of 1.96, I think we should actually be applauding most manufacturers to have survived at that level. Because if you look at it, Nigeria today, if you look at inflation rate at 21+%, if you look at the impact of FX, from the year beginning, if you take off the parallel market at about 500, which went to its highs of 900 at the end of the year, back to the 700, take the official position, which has always ranged between 412 to 440, and you're looking at those negative impacts. FX rate impact, basically the FX risk was a bigger risk to most businesses because it impacted businesses at negative of over 40%, 50%. And how do we look at ourselves today and not tap ourselves on the back that we survived? I think the critical word for most manufacturers is you applaud them for even surviving.
Survival.
That was the real thing.
All right, so we've seen the global central bankers have raised rates, and it's like a non-stop process, at this time. And even back here, we've seen the central bank governor also raise rates. The MPC, they've raised rates about over three times this year, and the expectation is rates will still keep going up as long as inflation, keeps rising, even though it's rising at a slower pace. But what is cost of credit like right now?
Cost of credit, of course, has gone up. Oh God, ridiculously. I think the first basis of increase, first two impacted, but I think everybody was still watching. I think by the time we got to the third one, and when we're getting to 16.5, I think the whole financial sector woke up that I think we're not charging banks, their customers more than, not enough. I think that's the right word. And the next thing, I think for most businesses, rates shoot up relatively more than 25%. Now you're saying some better averages between 22 to the 25s, but it went up as high as 30% for trade, and you're talking 28% for some businesses. Now, well, it's relatively getting a bit better now. I'll say it more like in the last 1 month. People have started reviewing, because really the negative impact of interest rate increase, of course, is business will slow down. Yes, technically, inflation goes up, you move interest rate going closer to inflation to impact the negativity of inflation to actually slow down the economy so that inflation slows down. Now, but at the end of the day, you're trying to slow down inflation. The effect of that is you're clamoring on liquidity by increasing interest rate. Increase interest rate, it will slow down people's expenditure, capital spend. It will slow down their way of buying. Now, but at the end of the day, when you start slowing down the system, you get the negatives. Now, especially for manufacturers and industry, that people like us who are impacted double whammy at the end of the day. You've gotten the interest rate risk issues, which is increasing at the pace at which is increasing. Then you also have the negative issue of the FX issue, which is impacting you simultaneously. So if you take your double whammy, you're talking businesses taking an impact of over 50, 60% on a year-by-year basis. Now, how do we then look at how do we mitigate that? Some aspect of it, give them the right thing. Yes, you've had all the intervention funds from everywhere you could think about. If not for those intervention funds trying to mitigate these increases, that has happened, I think, more than 3, 4, 5, 6 years now. I think that's been the lifesaver. You had people that had already taking benefit of the intervention funds. You had 9% interest rate. During the COVID, it was 5% interest rate. So most businesses benefited. Now, you saw that benefit happen, and it trailed on. Now, the impact of the commercial rate going up against the NPR was not as heartfelt as it would have been if there was no intervention. So give and take, one of the good things was the government and the CBN did right with the banks to do that, to mitigate what was going on the other side between the FX and the interest rate. Now, but at the end of the day, take above board, take across board, yes, there's still a negative, no matter how you look at it. And the question is, how much negative impact can we take? And we have to be very careful. Just like I was speaking to some bankers off the record, and you're looking at it, impact of both can create one major factor, which nobody wants to go back to for the bankers, NPL, non-performing loans. Now, the more you impact industries, the more you put negatives onto the system, the less people are able to pay, the likelihood your NPL figures for most banks will start going up. Then we go back to a crisis scenario. So there must be a balancing act. We need businesses to survive. We don't really need businesses to go down the drain, and then we have another crisis in the financial sector. So for me, I think what we need to do as a country, what we need to do as a financial sector is to create a balance. Now, how do we create that balance? That's the key question. The intervention funds, though, cannot last forever. Interest rate issues, yes, has to continue to go up because we still have an inflation at 21%. So most likely, as you just said earlier, it would still go up now because they're still trying to mitigate. But we need to create more alternatives to the impact that will enable businesses to grow, which means we must find alternative businesses, creating local content, for instance, which has been good. You have local content in most oil and gas. We need to make impact to pushing the impact of the negatives. Are you getting my point? So when you're trying to make impact, pushing the industry, you need to get these industries getting businesses. You need to get them working. You need to get most factories working. So if you take the oil and gas, for instance, which has a local content law, which has a benefit. Today you have a Train 7 that has $12 billion in project. And today they can say they have 55% local content out of $12 billion. So you've got, the more you can get other projects having more local content, I think we can pull ourselves out of our sorrows. And those are the key things, is to find ways for all industries in every way to sustain whatever they're doing in their businesses. And also we need to be very careful that policies that are created by government, irrespective, like just like the excise, because I'm chairman of my state manufacturers, and I have a lot of beverage companies in the state, for instance. And you have the excise law, which is now putting 10 naira of every liter of, and it's a big impact. The whole of the members are shouting and screaming about it. We need to ease. We're not saying it does not make sense to actually charge, but how do you ease?
It was like a double whammy for everyone here. The government looking for revenue, at the same time, and, trying to provide the enabling environment for businesses.
But they must continue to create a balance. the businesses are the ones that are paying the bills. They're the ones paying the taxes the most. They're the ones, if you look at the tax revenues, when you look at your VAT revenues today, if you look at your tax revenues today, income generated from pay, they're coming from private sector driven businesses. Now, if those businesses survive today and tomorrow, the government continue to earn more. If those businesses grow, you're guaranteed to earn more tax. If I'm more profitable, I pay you more tax. If I'm doing more sales, I pay you more VAT. Those are the realities. So if you stifle them and they die, what the heck are you going to collect? That is the point. So we need to be factual. We can be as technical as you are, but the reality is survival of the businesses and the growth of the businesses, which they've implied with all the intervention funds, lowering interest rate during COVID, is that they understand that those industries need to survive. If they don't survive, you're looking at 9 trillion that's been given in intervention fund today. 31% went to industry alone. Now, we believe there's more should be given to industry than they should have given, but nevertheless, it's a balance between today's world of agriculture and industry. I think agriculture has fared a bit better than we have in the figures, but the rest of it, you can't have agriculture without processing. Processing pushes it back to industry. And that is the fact that we need to push industry to the level at which it survives and takes us out of each crisis. So we're going through a crisis. We're going to 2023. What do we see at the outlook of 2023? I think the outlook is still a bit positive. Because
even with the uncertainties.
Even with the uncertainties, because luckily for us, certain things have been taking place that, if you look at it from the background and ignore the government issues and all that stuff, a lot of projects are in play. Modular refineries are coming in play. A lot of investments have gone into more modular refineries. The Dangote refineries is there. Petrochemical refineries are coming up with plastics, and those will set up other industries. Apart from that, infrastructural spending is a bit better than it used to be. And when you look at those factors and where the growth is, there's a gap. You have 200 million plus people, there's a gap. When there's a gap, there's investment. And I take, for instance, look, Ogun State happens to be the industrial capital of Nigeria, and I see the number of businesses growing. And if I look at the number of businesses putting factories in Ogun State alone today, it's astronomical. And people are putting long-term investment into things that you won't believe that is happening in Ogun State. If I look at the number of businesses that will open in 2023 that are under my own purview, it's a lot. But we must take that outlook, because there must have been a good reason. Nobody invests in anything and makes a loss in it, especially if you're taking people's money, investment money, you're taking banks' funds. You're not looking at the negative, you're looking at the positives. And I think the positive is, irrespective of the political risk that we have next year, give or take elections, take that off the benchmark, look at the consistencies of the investment in the intervention fund, investment in industry as of now, today. I'll say 2023 is still stable.
Stable.
The word is stable. It's stable. We're not in a negative. It's stable. The only risk is for every business today is to take a very good outlook into managing both the FX risk and the exchange rate, which is the exchange rate risk, and also managing their interest rate risk, because that is fundamentally going to affect all of us.
Right. So, well, a lot to look out for in 2023. Just a couple of days away, and we hope for a better outing, for the manufacturing industry going forward. Thank you so much, Mr. George Onofonwoka, CEO, Coleman Wires. It was great having your perspective today.
Thank you very much.
Thank you so much. All right, we're looking at the manufacturing industry in retrospect for 2022. Now, we head on now to see how investors, fared in 2022 and expectations for 2023. That's our next conversation. Do stay with us.